Well afternoon, ladies and gentlemen. Very warm welcome to this week's weekly market review. My name is Benjamin Goh, the Head of Research and Investor Education here at SIAS. With me is Sunny So, our Senior Technical Analyst, and we are very grateful for our Tiger Fund Management CEO, Jeremy Tan, to join us today. So we're going to be changing the format of this week's weekly market review. Instead of me and Sunny telling you stories about our university days, we're going to have Jeremy Tan give us his outlook for the second half of 2023 and perhaps a couple of nuggets of information regarding the property sector as well as the REIT sector, depending on how much time that we have. So without much further ado, we're going to get started with obviously the most important slide, which is the disclaimer. So the disclaimer is that SIAS is a registered charity. We are not licensed by MAS. So whatever that we talk about today, especially for specific stocks, cannot be misconstrued as a recommendation. So we do encourage you to speak to a licensed financial professional before taking any kind of action in the capital markets. Again, as usual, a couple of admin announcements before we get to the content. The upcoming ASEA session for the month of August is on the 16th of August. This is again on the evening of a Wednesday, 7 p.m. This is exclusive to SIAS members, so do use the QR code to chop your seat because we do have certain limited Zoom bandwidth. So make sure that you let us know you'll be joining. Next up is, of course, the Google review. Do use the QR code to give us a 5-star. Again, I'm being pretty blatant about this. But of course, if you think that we suck, then don't give us a 5-star, but we hope you do. If you are not currently a SIAS member, you might want to consider signing up. This is $1 per month for $12 per year, which is about the same price of a Burger King upsize meal, which is true. So I went to check there out over the weekend. Burger King upsize meal is about $12 to $14, depending on what you buy. This is actually about the same price or cheaper. And of course, you get to join our exclusive SIAS sessions every month where you can ask Sunny and myself any kind of question that you may have. So it's only $1 per month. There's a QR code. Use that to sign up. All right, without much further ado, I want to introduce Jeremy Tan. Jeremy Tan is the Chief Executive Officer of Tiger Fund Management. We are very grateful for him to join us today to give us his take on what may happen in the second half of 2023. We are very appreciative to Tiger Fund Management to be able to offer their CEO's time for us.
Okay, thank you very much, Sunny, Benjamin, for the very kind introduction, and thank you for the invitation to SIAS second half the market outlooks together with Tiger Fund Management. Tiger Fund Management is actually a sister company of Tiger Brokers Singapore, and I currently actually serve as a CEO of Tiger Fund Management. And previously, I actually served as portfolio management roles in private banks and also institutional fund houses, and have actually some track record in managing multi-billion assets of investments. Without further ado, I will actually go on into our market outlook segment. First, we'll look at the context of how markets have performed in the first half, the inflation, and also other macroeconomic telltale signs that we are seeing from the markets, and also a little bit on the US, Singapore, and the overall commodities outlook for the second half. If you look at the major indices performance in the first half, I think that has been actually powered by the developed markets, in particular US, EU, and actually Japan. And the main reason is because we are actually seeing the peak of that rate hike cycle for major developed markets, in particular US and EU, that are actually starting to signal a pause, if not an end, as soon as the end of the year, or if not 2024. And last year, given the very sharp increase we have in rate hikes, we have seen that volatility rise very, very sharply. And as a result, the major indexes, in particular S&P 500, NASDAQ, actually fell by 20% and 30% respectively. And this year, we are seeing that normalized volatility, adding that sense of assurance to markets, and actually that risk-on sentiment back into markets. We are actually seeing that global growth is actually more resilient than we thought in the first half, in particular US markets. Looking at the first quarter, it has delivered 2% growth in line with its long-term growth averages. I think coming into the start of the year, I think no one actually expected the markets to be rallying so sharply. A lot of that came about from the AI thematic team, especially after the revision of Nvidia's earnings that actually drove the overall AI thematic baskets in the S&P 500. While the breadth of the recovery is not actually very wide, in fact, it's actually very narrow. In fact, only in a few of that big tech, I think we do think that equity market performance will actually broaden. In the first half, I think the improvement in the market by the S&P 500 and the Nasdaq in the tune of 19% and 34%. I think that actually came not without uncertainty in the markets. We have seen in the first half, that the markets actually overcoming the debt ceiling crisis, some geopolitics, the rising interest rate and FX uncertainty, and also we have seen right at the start of the year at least three banks having failed due to the banking crisis as a result of that higher interest rates. Singapore, I think, continue to remain resilient in the start of the year, and coming in from a very strong start in 2022, and this year, I think it has underperformed a bit, but I think it still represents a very strong safe haven allocation to our investments. I think traditional economy, I think baskets of the STI constituents, in particular financials, have actually faltered this year. I think it has corrected somewhat from the very strong performance last year because interest rate cycles have actually peaked and also names have also peaked according to many major banks' guidance. So actually, we are still cautiously optimistic in the second half. I think the wall of worry that the rate hike cycle is actually over and the risk of inflation has already started to slow. Looking at the S&P 500 on the technicals front, I think the 50-day moving average have actually crossed at the start of the year in February. And if you look at right now on the levels, right now S&P 500 has actually recovered all of the losses last year in the span of the market year-to-date rally. Inflation right now, in particular, has been a worry last year, but I think this has sort of seen some silver lining. US CPI this year has started to see that trajectory fall from the high of about 9% to about 3%. And the US PCE index have also started to fall to around the 4% handle. While this level is still much too high compared to the long-term 2% target of the Federal Reserves, I think that the Federal Reserves will continue to hold its monetary policy to make sure that US PCE CPI will go down to its long-term healthy level of about 2%. So what is actually still sticky in terms of the inflation, as you might know, is the labor markets that continue to remain strong and rents that are continue to remain sticky in terms of the inflation. And this will take time for the monetary policy to actually start to take effect in the second half. If you look at the Federal Reserve's policy right now, since the start of July last week, last week we have seen federal funds actually raise to about 5.25 to 5.5%. That is actually after a brief pause in June. Most actually market participants actually forecast that the Fed will actually cut rates after the banking crisis, but the Federal Reserve continue to hold on to its monetary policy, while the quantitative tightening, actually was stopped in the banking crisis. But I think Federal Reserve has started to tighten a little bit more as the banking crisis has subsided. So if you look at the Fed Fund futures by the end of this year, there is actually a 60% probability that Fed Fund futures rate will still continue to be about 5.25 to 5.5%. So we can see that the regime change for the Fed is that there will be a higher for longer rate environment, and we could only see a pivot probably in the early part of 2024. In terms of the Federal Reserve's dot plot, I think that it also paints a similar picture. The Federal Reserve's dot plot was actually adjusted from last year to this year by about 50 basis points, which means that there could potentially be one more rate hike on the horizon, perhaps in September, and there will be no form of pivot. And if you look at in the coming year, the Federal Reserve's median Fed Fund dot plot actually signals about 100 basis points cut in 2024. Just now I mentioned this year, part of the positive sentiment actually came from the US GDP, while many analysts and economists were actually forecasting a recession. I think first quarter GDP continued to show the resilience of US GDP to grow by about 2%. And I think that second quarter will continue to remain in line. So overall US GDP, I think this year in 2023, I think we're expected to grow by about 1.5%. And that is actually bolstered by the strong consumer spending and also exports that is boosting the upward revision in GDP numbers. And just now I mentioned the US services industry continue to remain quite strong with the reopenings team still in play. Labor markets continue to be very strong, particularly in the services sector, despite the tight monetary regime, which means that this is a very strong Goldilocks kind of scenario. Looking at the yield curve tends to be a predictor of economic cycles that has shown inversion for the longest part of since last year to this year. I think the uninversion of the yield curve can only come when the economy starts to slow and the US starts to pivot in 2024 when the short-term interest rate starts to come off. Then only we will see the uninversion of the yield curve, and then only will we see the recession start to play out perhaps over the next 12 months. But we think that the magnitude of the recessionary risk is actually quite small. Looking at the volatility, just now I mentioned last year was really a very volatile year where markets were actually very uncertain of the Federal Reserve's policy, whether the Federal Reserve will continue hiking and whether inflation can be controlled. While this year, I think we have seen that risk actually started to fall back to the levels that we have seen in 2021 rather than in 2022. Back to around 15 on the VIX index, and that has actually drive the performance of risky assets this year. If you look at US equity market valuations right now, it's actually not it's actually not very cheap. If you look at the year-to-date rebound, that has actually sent US equity market valuations back to about 18.1 times forward PE. That looks actually quite expensive relative to history. So we are actually looking at perhaps more value and more quality in terms of our asset allocation rather than blindly chasing some of the AI wave that actually drove market returns in the first half. We think that perhaps in the second half we could see the rally actually broadening to other cyclical sectors when interest rate actually peak. So you can see that year to date, that return has been driven by the likes of Nvidia, Microsoft, Alphabet, Amazon, and Apple, Meta, and those were actually some of the names that actually corrected very, very sharply last year. In Singapore, I think closer to our hearts, I think Singapore, just now we mentioned, it has actually underperformed global equities, but I think it still has a place to stay in our overall asset allocation, given that interest rates are starting to come off. Oil prices have corrected. I think this is an opportune time to actually look at the STI index again. In particular, I think some of the key sectors that will continue to benefit perhaps will be in the form of S-REITs, trading at about 6.2% dividend yield and about 0.9 times price to book. Singapore economy is continuing to be growing. I think it could potentially evade a recession. And given that interest rates are expected to come off, I think the S-REIT dividend yields will continue to look more and more attractive after the correction last year. I think more importantly, a lot of people are actually concerned about the Singapore property after the sharp rally last year. I think Singapore property price index have actually fallen by about 0.4% in the second quarter. The government has continued to tighten policies, especially for foreigners coming to buy Singapore property. And it has also added new supply for local genuine buyers to meet demand. And actually, right now, the confirmed list for new housing supply stands at a 10-year high. So we expect that the growth in prices for Singapore property will start to consolidate, or in fact slightly slow for the rest of the year. However, we do not see there will be a sharp any catalyst that will result in a sharp correction. So I think the demand will still come from upgraders, in particularly for Singaporeans and PR upgrading from the HDBs to private residentials. And foreign demand will probably be slower given the very sharp increase in ABSDs. Looking at energy and gold, I think prices have corrected since the Russian-Ukraine war last year. It has peaked at about $120 in oil, and right now it's recovered to about to over $80. I think at this price range, about $80, I think this is a very sweet spot for energy producers to actually continue to make record returns for them. And given the very I would say attractive valuation compared to S&P 500 names, I think this would definitely be one of the asset allocation names that we will continue to add to our basket. And if you look at gold, I think with the interest rates starting to fall, I think and with the market looking for that flight to safety, in particular for the banking crisis that has yet to be solved, I think gold prices will continue to remain quite resilient in our favor. So overall outlook for the rest of the year, I think we continue to be cautiously optimistic, especially for the US market. I think it's right now in a tactically very bullish setup. Given that the first half it was actually driven by the AI thematics, I think in the second half we will continue to see cyclicals and other value names broadening out the overall performance of the S&P 500 returns. And I think probably the recessionary risk coming in the second quarter or in the second half, I think would be quite low. I think the Fed has managed to actually achieve a soft landing scenario for the US economy. And right now, I think it is probably quite important to continue to focus on value, quality, and some of the laggards, in particularly for the staple space, healthcare, and the energy space that I've just mentioned. In Singapore, the growth environment, while it's actually slowing from last year, it is to still continue to deliver positive GDP growth momentum. While manufacturing, finance, and trade is being weighed by the slower growth environment, we still continue to see services sector continue to mitigate that slowdown in the overall growth momentum. And Singapore market, I think, will continue to be a beneficiary when inflation starts to taper off, interest rates starts to normalize. I think that will be continue to be very positive for REITs, tourism names, and also other interest rate sensitive beneficiary could also start to recover. And with that, I'll hand it back to Benjamin and Sunny.
Thank you very much, Jeremy. So very illuminating presentation. I really like the part where you talk about the outlook in the US specifically. We're gonna kick off with a couple of questions. Hopefully we can go through as many as time allows. The first question that I have is, as you have spoken about just now, it does look as though that the base case is moving towards a soft landing in the US. So definitely 1 week ago, sentiment was different, but now 1 week later, it's kind of like market is going a bit berserk. All right, so given that that is now trending towards the base scenario, what's your take on the scenario where the US may have got higher interest rates for longer time, while the stock market is still running ahead as a bull run? How does that impact the Singapore stocks, especially the property as well as the financials?
Yeah, sure. I think the higher for longer interest rates in the US, I think has been already absorbed. I think most investors and also consumers are starting to get used to that higher for longer regime. So as a result, you have seen that volatility in the markets have actually come off. We do think that the higher for longer um, interest rate environment for this year is continue to stay. But however, I think this is quite at an opportune time where U.S. economy and global economy still continue to remain strong. Uh, and this is a point in time where the Federal Reserve can sufficiently raise rates to this magnitude without creating a hard landing. And so as a result, for this year, I think there has been some adjustments and also asset allocation adjustments due to the higher interest rate environment. Initially, banks did started to benefit, in particular the Sing banks and even the other global banks in terms of that rising NIMs. But we have seen that actually started to falter for the three banks in the US. And this year, I think we have clearly seen that flight to safety with regards to the asset allocation towards the AI thematic that actually corrected last year sharply. Do note that last year Nasdaq actually fell by about 30%, and so this year we are actually on that recovery mode. So this year we have seen the full recovery. In fact, it has recovered to higher than the 2021 levels that we have seen for some of the big tech names. For in particular for the Sing market, the Singapore market, property names I do think that will be a very challenging as I shared. Growth is starting to consolidate. Prices cannot go in a straight line upwards to that tune as what it has done over the last 2 years during the pandemic. And as a result, I think that we should refocus on some of that uh, names that probably continue to benefit from the reopening tailwinds. For example, tourism. I think we have just seen, the second quarter results, in particularly for some of the tourism names, in particular SIA. They have continued to deliver very strong results on the reopening tailwinds. And do note that China has not fully reopened as we speak. And some of the other names just now I mentioned, like REITs, in particular this year, given last year's correction when interest rates started to rise sharply, REITs had a very sharp correction in terms of the yield that they can give and also the gearing levels that they actually maintain on their balance sheet. So as a result, I think this year is a very strong option time with yields at about 6% and global interest rates starting to come off in 2024. I think it's good to start to position more towards that interest rate sensitive baskets beneficiaries.
Okay, so thanks, Mr. Jeremy, for the presentation that covers very widely, including on energy and gold as well. So I think my questions here would be just now when you were showing the CME Fed Watch 2, where we are projecting where the Fed funds rate will be. I think this is one of the professional tools that we also share quite commonly here on the SIAS Weekly Market Review with our users. So I hear your opinion that you might be seeing another 25 basis point hike maybe in September. And the CME Fed Watch 2, now the probabilities projection towards the end of year that we have already reached the peak interest rate, which is what was announced last week. Yep. So our opinion, at least for myself, the opinion that me and Benjamin shared during this show was that we think that if Fed needs to increase the interest rate, they will have to, as long as the economic data or the inflation numbers comes in better than expected and continue to go higher, then Fed will have to increase the rates further. So that is the investment thesis that we have. So as long as the economic data supports that, that means we have a better non-farm payroll data coming out this Friday, then definitely it would push Fed to increase rates further. So that would be something different from the dot plot chart, which you say earlier, which is now we are at the peak interest rate, which is why you have the opinion of another 25 basis point high. So this increase in interest rate that is not projected in the dot plot yet, which may change later. How do you see this increase in interest rate will affect the Singapore property markets or the REITs going forward? Will it be more challenged, and what are the risks that investors have to look out for versus the rewards that they are looking at?
Sure. I think the dot plot, even though the median levels does suggest that we are actually at a terminal rate already, but do note that the dot plot is not is actually a survey of all the governors, and there is also a higher bound interest rates that actually states that there will be probably another 25 basis points on the cards, especially in September. In particularly, I think if that actually happens, I think Singapore being a small and open economy and also an interest rate taker will also have to adjust rates, especially for our SIBORs and SORAs, will have to be adjusted in tandem to actually match on a lagging level against the Federal Reserve's Fed fund rate. So with that said, I think that further emphasizes on probably our call is that the property sector will continue to remain challenging given that interest rate costs, borrowing costs are on the rise. That will actually spur lower loan growth for the Singapore banks. And for the REIT sector, I think the probably the worst is I feel that it's probably over. Even though another 25 basis points increase, I think the worst of that is probably over. I think some of the REITs in Singapore have a very long duration in terms of the weighted average borrowing costs, and that in terms of that, I think they will be able to match their timing of their refinancing in light with the lower borrowing costs in 2024 and 2025. So this, I think we can continue. I think the correction has already priced in some of that risk already last year, and I think right now it is actually attractively valued in our opinion.
Thank you very much for that, Jeremy. So a different question. About half of the component stocks of the S&P 500 have already reported their results for this current earnings cycle. And the Singapore side, I guess we're just kicking off. So UOB led the charge with pretty good numbers last week. Can I get your take on what you expect for the Singapore earnings season this cycle?
Sure, I think you have rightly pointed out that about 51% of S&P 500 companies have actually already reported, and so far, interestingly, actually 80% of the companies reported EPS surprise, and actually 64% of S&P 500 companies actually that has reported actually reported a positive revenue surprise. I think in line with that, for the STI components, we have seen SIA, UOB, the larger cap STI names, they have also reported strong numbers, and we should expect to see that given that global economy is actually not as weak as we anticipated, some of the beneficiary, especially those that are not within the manufacturing basket or the export-oriented basket of companies, will continue to benefit. Just now we mentioned REITs on the back of reopening tailwind, SIA, and some of the other banks, I think with the continued higher for longer momentum, I think NIMs, despite having peaked, I think with the global market starting to roar up in terms of that recent momentum, banks will also benefit from fee income, not only from interest income, especially from their wealth management angle. I think we have seen some of that announcement, especially from OCBC and DBS, that will also start to report perhaps within this week.
Okay, I think in the interest of time, I'll just ask maybe the last one or two questions. So I saw your chart on the S&P 500 now. We are now about 5 or 6% to the peak that we saw last year. I think the first quick question will be, do you see that with the S&P 500 will retest the peak that we saw last year, which we are 5 or 6% away? And then on the Singapore front, the Singapore property as well as the REIT sector, is there any area, category or sector in the REIT and property that you favor, and which one you do not favor? I think we'll end off with these two questions.
Yeah, sure. I think firstly on the S&P 500, you have rightly pointed out that we are just marginally off the peak. So what will actually send S&P 500 to breach that peak levels that we have seen last year at the start of the year at the start of 2020, at the start of 2022, 2021, 2022 actually, is that the broadening of the market performance has to occur before that can actually happen. So the likes of the other names that I've mentioned, not within the technology basket, consumer services, and also the consumer discretionary basket. These were the ones that actually drove returns in the first half. So we would like to see that broadening out of the performance to actually the other names, especially in the energy space, staples, financials. This would be the big baskets that we would think that will actually drive performance. And we have already seen that with regards to commodity names actually starting to rally. We have seen oil prices and commodity prices already started to rally. So we are actually seeing that a bit of that cyclical rally starting to take place already. And with regards to your question on the STI, I think STI will continue because it has actually underperformed this year. It only delivered a very marginal positive performance. So what will actually require that impetus to drive performance is for perhaps, for instance, the financials and the REIT space will need to actually do better in the second half with expectations of interest rates starting to come off, markets start to roar, and then just now you mentioned property sector. I think property sector is one that is also a very important sector in terms of the loan book for Singapore banks. I think for now the property sector I think is rightly valued. I think it's probably in a more difficult space given that land costs, interest rate costs are still high for developers. I think it is probably continue to be challenging, even though we are seeing that genuine domestic demand is still very strong. We have seen that new launches is still undeterred by the rising interest costs. But I think what is important to say is that how can the developers continue to acquire land at current levels and continue to maintain the margins in light of the current scenarios where growth is actually starting to taper.
Great. Thank you, Raj, for that and your I guess opinions on the Singapore market is very well received. Very appreciative for your participation in our SIAS Weekly Market Review. We do hope to have you on our events more often. So definitely to pick your brains on what may be happening in the future. Thank you very much for joining us today. So for all our friends out there, this is the Weekly Market Review for SIAS. We are signing out. Have a great week ahead.
Thank you very much.
Thank you.
Thank you.